Hello, everyone, and welcome back to Stock Savvy, a series where we investigate an individual stock on the JSE, and every week we are joined by an expert guest. This week we have financial analyst Christian Bothma joining us. This guy knows his stuff when it comes to stocks. He is an investment analyst by profession. Christian, welcome to the show.
Hi, good morning, Paul. Thank you for having me.
Awesome. So, Christian, tell us about yourself before we get to the good stuff. I know you have a juicy stock for us lined up. Just a little bit, your investment journey. How did you get to where you are today?
Cool. Yes, I got interested in investment towards the latter part of my high school career. A specific mentor played a large role in my life, got me interested in stocks specifically. I started investing my own portfolio. I went on to study investments and economics, where I actually met you as well. Paul and I was in the same race, and we got to know one another at varsity. And after that, I finished my studies. I joined Sun Private Wealth. I've been working there as an investment analyst now for the last 5 years.
Awesome. So, Christian, Netcare. This is not a stock that we hear about often. It's definitely not a FinMeUp favorite or anything like that. But you and I often talk about this. Boring can be beautiful. So tell us about Netcare and maybe the industry as a whole. Give us some context there.
Cool, absolutely. Yeah, and as you said, it has certainly not been a favorite stock out there. I mean, if you just look at the stock price, in 2015, it peaked over 40 Rand a share. Today, it's trading below 14 Rand a share. So over the last almost 8 years, it's been a bit of a disastrous investment had you invested at the peak in 2015. Of course, you got some dividends in between, but all in all, it's been a pretty lousy investment. And if you look at the rest of the sector, it's broadly been the same. So let's look at the private healthcare sector in South Africa. You've essentially got three main players. You've got Netcare, they're the biggest in South Africa, about 10,000 beds, about an 18 billion Rand market cap at the moment. They've recently exited the UK, so they're now a pure SA healthcare player. And then secondly, you've got a company called Life Healthcare. They're the second biggest operator in South Africa. They've also got an additional part of their business in the United Kingdom called Alliance Medical. This is a diagnostics or a scanning business. It comprises about a third of their profits. They provide services mostly to the NHS in the United Kingdom. And then lastly, I think the one people are probably most familiar with is Mediclinic. They've obviously recently been taken private by Remgro and the Mediterranean Shipping Company. Mediclinic, of course, they're a bit more diversified. About a third of their business is in South Africa, and then the other 2/3 roughly split between Switzerland and the Middle East. I think before we get to Netcare, let's maybe give some context to where this industry came from and why it has been such a poor performing industry over the last 8 years. So the backdrop before the pandemic started in 2020 was this. You've had an insured life pool, so the medical aid membership base has been largely stagnant at about 9 million beneficiaries. That has not grown for the 5 years preceding the pandemic. So you had that on the one part. You also had a lot of new hospitals actually being built. So a lot of decisions made in the early part of the previous decade. So some hospital supply coming online, and then at the same time, demand not going anywhere. So what did this lead to? This led to the medical aid actually being in a very strong position where they could negotiate better with the hospitals, and you saw the introduction of the so-called network options. You might be familiar with that. Many of you might actually be on a network option. I think if you're a young person in this country, chances are you probably have some sort of a network option. What this does is it simply limits you to the type of or the hospital that you can go to. So the medical aid would negotiate with the hospitals, and in exchange for reduced tariffs, they'll put the hospital on their network list. So essentially, the medical aids got more power, and they forced this pricing power onto the hospitals, and the margins of the hospitals got a little bit depressed as well. Yeah, so even though the prospects weren't looking that great before COVID, there were still a few positive things about the sector at that point in time. I mean, you didn't really have the growth, but in the member base of the medical aid, but you still had an aging population. And so the older people get, the bigger the demand for hospitalization, of course. And then the second point to this is the hospital groups are still extremely cash generative. So because they're not really building any new hospitals to expand, rather focusing on growing in other settings, other non-acute settings such as pathology, radiology, or mental health. These are largely not that capital intensive, so they were very cash generative and they could pay a decent dividend to shareholders. So that was the context pre the pandemic. And then, of course, COVID hit, and I think the impact of COVID was a little bit different to what many people expected. Hospital occupancies was obliterated by the pandemic. You didn't have these COVID-19 patients in general offsetting the decline that you saw in other medical cases falling away, and also other elective surgery cases falling away. So I think that was the backdrop, but I mean, for all intents and purposes, we've been through the pandemic now for the last year and a bit, but still the hospital occupancy levels are not quite back to where they were before the pandemic. Netcare levels before the pandemic sitting at about 66, 67%. They're probably tracking full year averages of about 64, 65 now, so still a little bit below. It's mostly on the surgical side. Your medical cases, you might have noticed recently, people are certain, the flus are certainly back. People are getting sick again. Medical cases are back to where they were pre-pandemic. Surgery cases still lagging a little bit behind. But this recovery is playing out. You're certainly seeing those numbers starting to come through, and Netcare specifically is guiding that they expect these occupancy levels towards the end of the year at least to be more or less back to pre-pandemic levels.
Great. So we are on our way to recovery, yet the share price hasn't really done anything. I know a lot of companies, they took a massive slump in COVID, but ever since they've been recovering quite nicely. Not Netcare. Netcare is trading flat from 2020. So what's happening there?
Yes. Yeah, so I think the key reason has been this continued push out in the recovery. People have been expecting occupancies to get back to normal levels a lot quicker than it did. And then the second very important factor after COVID has been the poor South African economy. So COVID obviously impacted the South African economy's ability to grow, and the medical aid pool at best has remained flat. So that has been the sort of continued backdrop. So your margins, I don't think it's going to get back to pre-COVID-19 levels. And that has been a realization for the market over the last year. So they've had to rebase that. But I think if you look at the current Netcare situation in the context of the South African market, you do still have occupancies recovering back to COVID-19 levels. You've got pretty decent inflation pass through. The tariffs that they get from the medical aids are pretty regulated, so you basically get inflation every year, except for some of these discounts that you give on new network options. But you've got this recovery playing through, so in my opinion, you've probably got earnings growth for the next 2 years at least of more than 20%. Yeah, so if you look at Netcare in that context, and also if you look at the valuation of Netcare, if this recovery plays through on the occupancy side as we expect, and also towards the end of the year, you've got the digitization project where essentially they've been digitizing their health records, making them electronic. All the doctors and nurses now have iPads with them. And you've also had some catch-up capital that they had to spend to refurbish some hospitals. All of this got postponed during COVID. If all of this plays through, your cash flow per share from this year to next year more or less doubles. In my opinion, likely to more than around 40 a share. And that would put the business currently on a free cash flow yield, if you look 1 year forward, of north of 10%. And given the fact that their balance sheet is is very much in control. They don't have a lot of debt. They can return a lot of that to shareholders. So I think, just to summarize, in the context of the South African landscape where there isn't a lot of growth, I think Netcare can be a very nice defensive play to hedge yourself against that in this environment.
Christa, very interesting bull cases there. Maybe you can just reiterate it so we kind of have it on paper. And then I would love to hear your bearish arguments, because the economy is struggling at the moment. You have to be very careful in what you invest in. I know load shedding has been hitting a lot of companies very, very hard. And I also know there's something weird brewing in the background with the hospitals and the medical aid specifically. Maybe you can elaborate on that.
Cool, no, for sure. I think just to focus on that sort of base case scenario of ours, I don't think we are being overly bullish. I don't think we need to assume a very strong South African economy for this investment case to make sense. Your bull case would be if you actually have a stronger South African economy than people expect. Let's say we do miraculously fix load shedding within the next 12 months and the South African economy starts to grow, global economy maybe starts to grow, and that feeds through to South Africa. That would be, I think, your real bull case in this scenario, where things start to go right, more people can go into medical aid, and demand actually starts to pick up. In our base case, we don't really assume that. We assume they sort of muddle along, get back to more or less pre-COVID-19 levels, and then just become a sort of very cash-generative business that gives you a very good dividend yield and more or less grows at inflation. That's the base case, and we see valuation upside even on that sort of very depressing base case scenario. Yeah, so I think there's quite a few things that people can highlight. Yeah, I think probably the biggest bearish factor that people speak about is the so-called NHI, the National Health Insurance, and what would that mean for hospitals? Just to sort of explain it again a little bit. So what the government envisions is for there to be basically no more medical aids, where there'll just be a central government medical aid, and they will purchase health services for the entire population, public and private, and anyone should be able to go to any hospital then in that case. Now, I think most of us can acknowledge that at the moment this seems like a bit of a pipe dream, and the reality is we don't have the finances to do this at all. But let's suppose it does go ahead, because I think there are certainly scenarios, I don't think those scenarios may necessarily stop our government if they stay in power. So let's say it goes ahead. What happens then? I think the first point to make is it will be a slow and gradual process. If it happens, we've spoken to people close to this in the government, and they've confirmed that they'd likely start with sort of, let's say they start with cancer care and say patients with cancer care can now go to all hospitals, and then they start with something else and so forth. So it will be a long, stretched out process. It won't be on day one, there's no more medical aids, we've got an NHI. So if this slow process takes place, initially it won't necessarily be bad for the hospitals, because it will mean extra volumes, right? It might mean extra volumes at a reduced tariff, because the government might not pay the same tariff as the medical aids do. But even at the reduced tariff, if you can fill your hospitals up, as I've said earlier, your hospitals are like 65% fixed cost. So the cost is there. If you can add extra volumes, you can quickly see it being beneficial to earnings at the end of the day. So I think in that initial process won't necessarily be negative. But the longer term thing is obviously the more uncertain part. I mean, what does it mean for the entire healthcare system if we eventually move to NHI? And I think I don't think that would be a positive case for the hospital. Just one central buyer in the government means they've got all the power, and they can set tariffs, and they can essentially drive these hospital margins very low. So I think that is your real long-term bear case. But I would argue it's certainly not looking like the likely outcome at the moment. And if it happens, it will take a long time. The second one that people think is actually a big risk is load shedding. It's a much smaller risk to the hospitals than many other businesses. If you look at the retailers, I'm sure you guys have covered some of those results coming through. It's had a massive impact on their operations. You've seen what happened to Pick and Pay, the amount of load cost they've got to pay to load shedding and the impact to their profits. It's less of an impact for the hospitals. Why? For a couple of reasons. Firstly, electricity is a bit of a smaller component of their total costs, only about 5% of their costs. Number two, they've invested quite heavily in renewables. So over the last decade, they've all been building solar panels on top of their hospitals. So this helps alleviate the impact a bit. And then number three, they've got higher margins than the retailers. They're operating at like 15 or let's say mid-teen operating margins, and the retailers are low single digits. So extra increase in cost has a much bigger impact on the bottom line for the retailers. But that being said, they're not immune to it. They are impacted by it, and we estimate, depending on the stage of load shedding that you assume, it will hit Netcare's earnings by about 2 to 5%. So if load shedding stays at, let's say, stage 4, you can say maybe earnings settle 5% lower than it would have otherwise. So I'd say, yeah, those are probably the two. Yeah, which is not a change. It doesn't change your investment case. It impacts your earnings, but I don't think that's the main driver to the investment case. And then sorry, maybe a third thing which is also actually a massive risk is the nursing shortage in South Africa. It's certainly not unique to South Africa, but there's a lack of nurses in this country, and also a lack of nurses being trained, which again is quite frustrating, because these private operators, they can probably train north of 8,000 nurses a year. They're being allowed at the moment to train less than 1,000. So they're offering their help to train more nurses, but the Nursing Council is fighting this. So this is a real sort of problem brewing, and the sector needs to sort of collectively bargain together to be able to train more nurses. I think it is something that will be fixed, but if you don't start training enough now, the risk is that influences your costs. You will find the nurses, but you'll have to pay them more, and that of course influences your margins as well. So that's another, I think, bear case scenario that you can point. So those are three, I think, bear cases. Sorry, go ahead.
Just curious on that. Why would the Nursing Council not allow for more than 1,000 nurses to be trained a year?
So that is only in the private sector, 1,000. There's obviously a lot being trained in the public sector, but there's not enough capacity in the public sector to train for the demand that there is. But the short answer, that's a very good question. From a selfish perspective for a Nursing Council, they want there to be lower supply of nurses, because that means higher wages for the existing nurses. It's like all bargaining councils. But at the end of the day, they also shooting themselves a bit in the foot, because the more nurses you train, the more members you can have to unions, and it's obviously bad for the economy. We've got an unemployment rate north of 40%. It just doesn't make sense that the government wouldn't step in here to intervene and offer more capacity to train nurses. But unfortunately, that is the reality, and that is what the guys are battling with on the ground.
Yeah, that was a brilliant bearish scenario segment. Thank you for that, Christian. So maybe for the last segment, highlight the key bullish and bearish factors just once again so we know it, and then the juicy part, the valuation, where the share price is now and where you think it's going within the next year or two.
Sure. Yeah, so I think just to summarize, I think base case, we think the South African economy sort of muddles along. The hospital sector manages to improve their occupancy levels towards the end of the year. In Netcare specifically, you've got these costs falling out because of the digitization project coming to an end. So you actually see very nice earnings growth over the next few years. The bullish case to that would be you could actually get a stronger South African economy, and you see occupancies for medical aid members rather improving, and also occupancies moving higher than people previously anticipated. The bear case scenarios, the first most foremost would be a continued very weak South African economy, or even further deteriorating South African economy, and then risks associated with potentially the NHI in the long term. We've concluded load shedding perhaps not as big a risk for them, and then also the nursing shortage quite a big risk as we go towards the end of the decade. So those are the sort of bull bear cases. Where do we see the Netcare valuation from here? So as we mentioned, if these, on our base case assumption, we think there's a very good chance that cash flows will almost double from this year in September to next year September. And if you sit at that sort of R1.40 a share cash flow, the question is, what would you pay for that? I would argue a stable business like this, you can easily pay a 12 to 14 times multiple for that cash flows. Of course, your earnings will be even a bit higher than that. So in my opinion, you're probably sitting north of 20 Rand a share here in a normal scenario. Will the market pay that for them at the moment? I don't think so. I think the market will want to see these numbers come through, but I think it's very hard to see the share price staying where it is if Netcare does in a year from now deliver that type of cash flows and actually pays a very healthy dividend to shareholders. So from the current base, we see significant upside even in that sort of just muddling along scenario for South Africa.
Great. I think maybe based on this conversation, I'll dip my toes in the water with Netcare. I do have a little bit of cash on the side. Christian Bothma, thank you so much. Maybe any last thoughts? Or are we leaving it north of 20 Rand a share? That's the one for socials.
Yeah, I think let's leave it there. That's the pick, north of 20 Rand a share. Let's see where this one goes.
Awesome. Thank you everyone for listening. We'll see you next week for another episode with Josh Viljoen. Have a nice week, everyone.